Heavily shorted stocks can make extreme moves in price. There's also nobody better to beat in the market than a short seller. This is the Tradespotting video on how to find, understand, and exploit short squeeze opportunities. I'm Tradespotting, probably one of the world's most well-known short squeeze traders, and this is my guide to making the most of these extreme price moves in short squeeze plays. Welcome to the video. Hit the like button. Short squeeze opportunities becoming an increasingly popular part of the retail trader's playbook. This is because those heavily shorted stocks can make these extreme moves in price, often referred to as the squeeze. This is when sellers rush to close their positions. The phenomena occurs due to a combination of factors. Forced buying. Short sellers initially borrow shares that they don't own and then sell them, hoping the price will fall and they can buy them back, close the position, make a profit in a non-taxable trade. When the stock price starts to rise, short sellers may face margin calls. This requires them to deposit additional funds to cover any potential losses. If they can't or don't want to meet the margin call, they have no choice but to buy back the shares, which creates additional buying pressure. Fear of unlimited losses. Short selling involves unlimited potential losses. If a stock's price rises significantly, there is no upper limit to how much that short seller could lose. To limit their losses, short sellers often have a predefined stop loss or a predetermined exit strategy. And when price reaches these levels and breaches those areas, they could be forced to buy back their shares, which further drives up the price. And with good technical analysis, we can predict these prices on the chart. Short squeeze feedback loop. As more short sellers rush to close their positions, the increasing demand for the stock drives up the price. This, in turn, triggers more and more short sellers to close their positions to limit their losses, which fuels further upward momentum. And that creates a feedback loop of extreme buying pressure. A lack of supply. If a stock has a relatively small float, that's the number of shares available for trading to the public, it can be easier for a short squeeze to occur. With a limited supply of shares in the market, heavy buying pressure from short sellers to cover their positions can quickly drive up the price as there aren't enough shares readily available for them all to buy. Positive catalysts. Short squeezes are often triggered or exacerbated by positive news or developments related to the stock. This also could be strong earnings reports, favorable legal outcomes, partnerships, or other positive events, perhaps related to activity online. These catalysts can attract new buyers and cause short sellers to reassess their positions. Market sentiment and speculation. Investor sentiment can play a significant role in short squeezes. When traders and investors see a heavily shorted stock experiencing a rapid price increase, they may jump in, speculating on further price appreciation. This additional demand then pushes the stock even higher. And finally, but most importantly, technical indicators. Traders and algorithms use technical indicators and chart patterns to identify potential short squeeze candidates. If a stock's breaking through key resistance levels or forming a bullish pattern, it may trigger a buy signal for technical traders. It's important to note that short squeezes can be highly volatile and therefore very risky. While they offer the potential for large profits for those in the long side, they can also result in significant losses if you don't time your trade correctly, or indeed if a short squeeze occurs and you're on the wrong side of the trade. Traders involved in short squeezes should have a clear exit strategy and a risk management plan, as the rapid price fluctuations can make it very challenging to time the market effectively, and sometimes life can make decisions for you if you don't plan in advance. Additionally, The timing and intensity of short squeezes can be very difficult to predict, and not all heavily shorted stocks will squeeze, which is why a top recommendation is to pay attention to Tradespotting. One of the most important ratios when investigating the potential for a short squeeze is the short interest. This refers to the total number of shares of any security that have been sold short by investors but have not yet been covered or closed out. In other words, it represents the total number of shares that investors have borrowed and have sold in the hopes of buying them back later at a lower price. High short interest then represents that the dominant sentiment in the market is bearish, even if it doesn't refer to the number of market participants, which is very important because if new market participants enter, then that will change the dynamic significantly. If it happens at the same time that shorts are closing, you'll find that on the charts at support and resistance, you could see huge moves. So it's not necessarily the short interest figure itself, it's the sentiment it represents and the moves that could come off the back of that dynamic, which can change. So the changing figure with regards to short interest, very important. And the detail of that change is when it's reported, where it's reported, and the difference from the last report. Those questions answered now. Short interest is officially reported every 2 weeks by the stock exchanges, such as the New York Stock Exchange or the NASDAQ, and it's often available on financial news websites, brokerage platforms, and the exchange's official websites. But I've got it here from FINRA, and I'll put the links in the description below. I've also got the most recent short interest report, which provides you with an interactive grid where you can list those tickers by their symbol, the previous short interest, their current short interest, or the percentage change from that previous report. So here you have the reporting dates, and it shows, say the settlement date was the 13th of January, then the date for reporting that would be the 18th, 1 week later, and that date's published on January the 25th, so 2 weeks later, which gives us a 2-week lag on that data being reported. Many others would describe a high short interest figure as indicative of a large number of investors betting against the stock. That's not necessarily true because it's referring to the shares, not the market participants, but it does speak to the dominant sentiment. And it suggests the potential for a short squeeze, especially if there are positive catalysts or the stock price starts moving rapidly. Short squeeze potential increases when the days to cover ratio, which is the short interest divided by the average daily trading volume, is high, indicating it could take a long time for those short sellers to cover their positions. The whole time that price would be rising, causes the potential for an exponential increase, that is doubling the price while halving the amount of time that takes to happen in series. The danger of using this lagging data is that short interest data that doesn't necessarily represent then the real-time market sentiment. It's also true to say that during this lag, market conditions could change significantly, making the data less reliable for predicting a short squeeze. And you say investors here might miss out on this opportunity by making decisions on outdated information. You'd be right. You have to pay attention to the charts, not just singular figures at any snapshot in time. Along with short interest, we have that days to cover ratio, and I'll explain a little bit more about that and other important ratios used by those traders investigating short squeezes now. Days to cover. This is a very interesting ratio that's used alongside short interest to give you an indication with regards to the sensitivity of any potential squeeze. Days to cover is calculated by dividing short interest by the average trading volume. So the average trading volume is the amount of shares traded on any given day. And if that figure is very, very low and the short interest is very, very high, then you're going to get a very high ratio for days to cover, a high short interest, which makes it very difficult for shorts to close their position. And that speaks to the sensitivity and the potential for a really big squeeze. Other popular ratios among traders for heavily shorted stocks include the utilization rate. This indicates the percentage of available shares that are currently borrowed by short sellers. A high utilization rate suggests high demand for borrowing the stock, which suggests then that borrowed shares will later be shorted. There'll be an increasing number of participants or shares going short on the stock, leading to a potential increase in the short interest. The cost to borrow, an incredibly important metric. This represents the fee that short sellers pay to borrow those shares. High costs could indicate high demand for the stock. If a lot of people want to borrow it, there aren't very many available, the price to borrow will go up, and that'll indicate then the difference between supply and demand with regards to that particular dynamic, again used alongside short interest. Very important, because if the cost to borrow starts increasing dramatically, that might be a signal that shorts are going to start closing soon. Also, cost to borrow is quite an intricate calculation that you as a retail trader won't ever have full oversight, because the lending desk that organize and facilitate this particular mechanism have also often got very custom bespoke plans in place where both the person borrowing and lending the shares benefit from any increase or capital appreciation from the utilization of those borrowed shares. Also important, put to call ratio. This compares the number of put options, those are trades betting that the stock will go down, to call options, those are trades betting the stock will go up. An unusually high put to call ratio can indicate bearish sentiment and potential for a short squeeze if the stock rises. A lot of people will have seen me using the put to call ratio to call SPY closes for 0-day or weekly options on SPX and SPY. Float. The float is the total number of outstanding shares. So a low float means a low number of outstanding shares. Outstanding shares is all of those available for trading by you, the public, apart from restricted shares, insiders, and those held by major stakeholders. In the context of a short squeeze, the float size then plays a crucial role in determining the potential of that squeeze. Low float, low availability of shares, harder to cover or close when the time comes. So when a stock has a relatively small float, it means there are fewer shares available for trading in the open market. And if a portion of those shares is shorted, that is sold short by people who don't yet own them, then they might have to buy them back. Any positive news or catalysts could cause a rapid price surge. High short interest ratio on a limited float. So if you take the short interest ratio, which is calculated by dividing the total number of shares sold short by the stock's daily average trading volume, a high short interest ratio on a stock with a small float indicates short sellers are going to struggle to find enough shares to cover their positions promptly. And again, intensifies the buying pressure, potentially increasing that squeeze. There's also another important factor to note, which is much more murky and ambiguous about the impact of dark pool trades on float sizes. Dark pools are private, off-exchange trading platforms or alternative exchanges where institutional investors trade large blocks of shares away from public markets. Dark pool trades don't immediately impact on the public exchange because they occur in private. However, they can indirectly influence the float size and short squeeze potential in the following ways. Dark pool accumulation. Institutional investors often use dark pools to accumulate large positions in a stock without causing price spike or being seen to do so. If these investors are accumulating shares with the intention of triggering a short squeeze, then those actions wouldn't be immediately available. So this is one potential positive aspect to dark pools with regards to short squeezes. But it will have a delayed impact on the float. So when shares are bought or sold in dark pools, although that those trades may hit the ticker immediately, the active trading period and who it is that's accumulating or distributing isn't immediately available via the dark pool. So this can hide the actions from the broader market and make it more of a surprise. So the dark pool aspect does give a degree of unpredictability with regards to timing. Information lag. There's also an information lag. For public investors will not be aware of any accumulation or distribution happening in these off-exchange markets until such times as the trades are being recorded and start re-influencing float size. That would allow institutional investors then to accumulate discreetly. So float size, total number of outstanding shares, is relevant with regards to the short interest ratio, dark pool accumulation or distribution, delayed impact on the float from that dark pools, and information lag as well. So in summary, a small float combined with a high short interest creates favorable conditions for a squeeze. Dark pool trades, by influencing the float size and giving institutional investors a discrete way to accumulate positions, can have an indirect impact on the potential for a short squeeze. So pay attention to the float size. The smaller, the better. So the benefit from my experience of doing this for all these years, you want to be targeting stocks for a short squeeze which have got a high short interest. That's approaching 10%. Anything above that, or even crazy at 20%, you're in for a really big potential squeeze there. Days to cover, you want this to be as high as possible. 10, very dangerous. 20, incredibly dangerous. But even approaching that figure of 10, 8 days can be extremely risky for shorts, especially if there's a low float size. Outstanding shares, low availability, high utilization rate and high borrow rate with a low float size means that shorts could be in trouble, especially if the short interest or days to cover spikes. And then put to call ratio, you want to see this above 1. You want to see more puts than calls, because the put to call ratio speaks to open interest of all derivative positions. And the only way for a long derivative to close is to take the opposite side of the trade. And that has an impact on the available shares because of the market maker situation, the way that derivatives work. So you want to see a high put to call ratio, which means the only option for shorts then is to close rather than increase the short position. And you get all of these factors at the same time. You find support and resistance on the chart, and then boom, you're flying. You've also got a particular set of indicators which can make the execution getting in really easy. I've got a very good signal for that. And we've got the Rocky Outcrop Flash, which is a genius and game-changing way of taking profit. So definitely check those two things out. Right, back to the video. You don't want to just hodl these stocks forever. You want to actually take profit. Then you'll need a target. The best way I've found is with the Rocky Outcrop Flash. You get it at www.patreon.com/rockyoutcrop. Select the indicator tier and you get free access to the Discord, where I spend all my time educating people just like you. So check it out. I also use that for taking profit on all my trades. It's a really efficient way to trade. So I'd recommend that. I'll put the link in the description below. And it's probably the most important link down there. And if you want to see the reason that I've been making this video, I make this video because I hope you'll be properly prepared for an amazing short squeeze opportunity which is coming up. That video will be on my channel shortly after this one. Thanks very much for watching. If you'd like to join the team and become a bigger part of what I do here, join me at the Discord, www.discord.gg/rockyoutcrop. And if you'd like to support me in this job, links in the description below. Thanks for watching. Take care of each other. See you in the next one. Like button, please.